Hello and welcome to Stockwatch Live. With the May Day bank holiday and the arrival of spring, thoughts might be turning to long summer days ahead and holidays. Timely then that in the week ahead we hear from two travel companies. One is an old favourite, albeit after a bit of a rebrand, while the other is a relative newcomer, taking advantage of holidaymakers' appetite for buying online. First up on Tuesday is the travel operator formerly known as Thomson. A stalwart of the package holiday industry, TUI, as it's now known, has had to overcome some major obstacles to remain where it is today, and not all of them could have been predicted. As well as terrorism and political uncertainty, the company is increasingly hostage to the pressures on consumers' pockets. Life certainly hasn't been a beach for TUI. However, the holiday and tour operator has weathered the various storms, and the outlook for summer 2018 would appear to be sunny. With its geographical diversity, an improving Eurozone economy, expanded capacity and group rationalisation programmes underway, along with that rebrand, investors will want to hear that everything is as it should be as we head into the main summer holiday season. In February, TUI said first quarter revenue had been boosted by strong demand for Western Mediterranean destinations and said holiday hotspots in Turkey and North Africa were continuing to draw holidaymakers back. First quarter revenue grew by 8% to €3.5 billion, and with current trading in line with forecasts, the expectation is for sales growth of around 3% this year. Barclays Capital remains overweight on the shares and has lifted its target price to £18. HSBC says the shares are a buy but has a target price of £17.35 on the stock. On Thursday, it's the turn of acquisition hungry On the Beach to post half-year results. The online holiday website, which already sells a fifth of online short-haul beach breaks in the UK, shows no sign of sitting back and taking a break though. In February, it revealed that sun, sea and sand-seeking Brits have kept business booming. UK revenue was up 23% in just the 4 months to the end of January, driven by growth in its core business and substantially higher revenues from sunshine.co.uk, which it acquired last May. The demise of charter airline Monarch also boosted seat prices significantly, the company said, especially over the winter period. But with other carriers boosting their capacity since then, prices from Easter onwards are expected to remain broadly flat. Last year, On the Beach saw pre-tax profits grow by almost 34%, and investors will be keen to hear about the development of the company's international sites in Sweden and Norway, which should have continued to show strong growth. The group will also shortly launch its international proposition eBeach into Denmark. Brokers Berenberg and Peel Hunt both rate the shares a buy and have raised their price targets to 600 pence. Now, after Apple's staggering $100 billion shareholder giveaway, the biggest in the history of any company ever, Paddy Power Betfair's £500 million cash return to shareholders might not dominate headlines in quite the same way, but its timing is interesting. Not only does it come at a time when the betting group admits 2018 profits may not be any higher than last year's, but it also comes just as this month the UK government is expected to deal betting shop owners a losing hand by slashing the minimum bets that can be made on fixed odds betting terminals, those controversial machines that allow punters to wager up to £100 every 20 seconds. The gambling industry has long protested that this move will force shop closures and cut jobs. And in Australia, meanwhile, Paddy Power and its competitors are being hit with new taxes and more stringent advertising rules. So Tuesday's trading update from one such competitor, William Hill, will make for interesting reading. With new chairman Roger Devlin in place, shareholders will want to know how these changes will affect business. William Hill did slide into the red in 2017 after writing down the value of its Australian assets, although underlying earnings grew and the company lifted its dividend. Now, back in January, William Hill mooted the idea of the sale of the troublesome Australian business amid the introduction of a credit betting ban in Australia. And in March, the deal was done, netting it £176 million. The sale proceeds will be used initially to cut debt than to invest in further growth, the company said. Broker Numis rates the shares a hold and has a price target of 341 pence. Citigroup says they're a buy up to 380, as does Deutsche Bank. And finally, some food for thought. Greggs the Baker is due to give us a trading update on Wednesday. Once famous for its cheap and cheerful sausage rolls, it's moving into healthy eating and trialling a drive-through. Greggs reported 3.7% growth in like-for-like sales in 2017, down from 4.2% in 2016 amid a challenging consumer environment. The company said economic conditions became more challenging in 2017 as business cost inflation rose due to food ingredient and labour cost increases. This contributed to year-on-year margin slippage. Pre-tax profits fell from £75 million to just under £72 million. With tightening consumer purses taking a bite out of many eateries' bottom lines, the focus for Greggs has been on adapting its offering to meet customer demand. Its priority has been developing the brand as a leading food-on-the-go offering to rival the likes of Pret, Costa and McDonald's. That includes an ambitious plan to roll out a record number of new shops in the year ahead. Broker Berenberg rates the shares a buy and has raised its price target to £14.50. Well, that's all we've got time for, but to find out about other companies reporting in the week ahead, go to the Markets and Insights section on fidelity.co.uk. Thanks for watching.